all right. Today we have an awesome guest, a repeat guest, Jack Krupey in the house. How you doing today, man?
I'm doing great. It's great to be back.
Jackie boy, let's go. I'm excited to have you on. It's I wasn't here for the first time you were on. So, I'm excited to hear your story. I've heard amazing things from Dave. I think Dave probably could do a great intro on how you guys got linked up. But I'm personally excited for this one.
Yeah, I'm going to be honest. Jack had a major impact on where we are today. And I don't think Jack gets any credit for that. I don't think I've ever told you. But we were at CG. I did a presentation on social media, branding. And he pulls me aside and he goes, have you ever thought about just raising money? And I'm like, well, maybe. I mean, that's not really necessarily my forte. I'm really a deals guy. And he's like, listen, there's a whole world of finance out here that you're not monetizing, and it's actually significantly more lucrative and less of a headache. And so he introduced me to the fund to funds world, right? How to basically find great deals, great operators, better than yourself, and invest directly into their assets and their projects, and helping your investors achieve really solid risk-adjusted returns, and really creating a win-win for everyone involved, the sponsor, your investors, and yourself. And so that opened up a whole world for me. And since then, I've done a ton of research on it, and we're actually doing 2 deals just like that. And so, Jack, thank you for making us millions and millions of dollars, man.
My pleasure. I just, whatever. I can't help it. I'm an evangelist. If I see something, I say something. I saw you had pretty solid marketing, and you have a finance background as well. I still can't do much with an Excel spreadsheet, and I know you're built models for a couple of years, so you have all the pieces to really be a syndicator and be a capital raiser. So I'm glad you ran with it, and maybe I'll order some more expensive scotch when we go out later.
I was gonna see he's probably waiting for that referral fee on the way.
You got it. It turns out I actually have a dinner to attend after this podcast. So I'm just kidding. No, we'll get some scotches, man. So Jack, what we didn't get to do on the first podcast is really get to know your background story and what makes you tick. Can you kind of just share with the audience?
Yeah, absolutely. So, and it's actually good timing to be telling this story because I got out during the .com crash. I've been through 3 or 4 recessions already, and making me feel a little bit old. But I thought I was going to be in the IT industry. It was the late '90s. I just got into the internet early on with AOL and Prodigy. This is probably way before your all's times here.
I had AIM instant messaging.
Oh, okay, yeah.
I did away messages.
Yeah, I had AOL with you couldn't even answer the phone.
I actually got broken up with on a girl's bio. It had,
or the status.
It had my name in a heart, and it said Eric in a heart, and then one day it had someone else's name. That's how I found out. Horrible.
Oh, so I was helping real quick aside, I was helping my mom a couple years ago with her computer, and she was the last paying customer for AOL. She had just never canceled it, and they were still billing her $9.95 a month. Way. So I had to ever cancel AOL. I think this is 2019. It was embarrassing.
Holy moly.
So I basically, I went up to college in Rochester, New York. I was really into the internet. I was just fascinated how everything just connected together. And thought I was going to be some high-tech computer consultant, and then 2001 happens, and luckily I had a job. There was I had an internship in New York City, and then there was a consulting firm in Rochester. So I had a job, but it wasn't really as exciting as I thought it would be. And I was making $50,000 a year in 2001 in Rochester, which is actually pretty good money. With inflation, it's probably, a low 6-figure job. And, I think my house, I had 2 roommates. I was paying $250 rent. Lived behind the bars in Rochester, and I was living like a king. And with that said, I wasn't really fulfilled with my career. And it was a couple months after September 11th, so airfares were $100. And me and my buddy Steve went to Vegas for a 4-day weekend, and I saw the glitz and the glamour there. And I'm playing with $50 at $5 hand blackjack, and I just see people throwing around money. And I was like, I need to do something more. I just sensed I wasn't gonna have any immediate path to make additional money. So, and before that, my aunt had bought me Rich Dad, Poor Dad. So I read that book for my high school graduation. So I had some familiarity with, assets and liabilities, and that real estate was one of the ways. And I bought this book at Hudson News. It's one of those paperbacks, like How to Make $1 Million in Real Estate. It was like a Grant Cardone book before Grant Cardone was in the business, basically. And I get back to Rochester and was all fired up and called my landlord. And he was a real estate broker who owned about 15 buildings in and around Rochester, mostly in the college areas. And this was 2001, 2002. So if you could fog a mirror, you could get a mortgage. And 60 days later, I've got a house almost no money down. It's like a $60,000 two-family, rented for $1,100 a month, and just jumped right in. And within a year after that, I had 4 of them. Did a lot of creative financing. Had a couple assumable loans. There was still FHA assumable back then, where I was able to basically. I think I bought one house for $384 down.
What?
And it was underwater too. Not physically underwater, but Rochester.
The mortgage was more than the value.
Yeah, this was Rochester, and they hadn't really recovered from, Kodak and Xerox. It was it's not quite a Rust Belt town like some of the others, but, it was not exactly a booming economy at the time. So it was a really good place to get started because it was cheap, and, on a $50,000 salary, I could get into a few houses. Then we started doing
sorry to cut you off. Yeah. You were still working your 9 to 5 at the time?
For about a year and a half. Then I think I picked up a first investor that had a few $100,000 in private money, and then that was really when I made the jump to go on my own. And then got my broker's license, did some wholesaling. We sent postcards. This was well before the era of texting and all that stuff, but we bought these little yellow postcards, that we buy houses type cards, and it was $700 of investment. I was afraid to do it, and I think we made $100,000 on that mailing.
Wow.
We were sending to landlords, absentee owners, and
that's some good ROI.
Yeah. It's one of those lessons I sort of try to remind people now, is that you can't be afraid to spend money on marketing. Nowadays it's Facebook and other things, or I don't know if direct mail still works. Do you guys even bother with direct mail? Or
it works. We don't really do a lot of it, but it definitely.
It's like a 1.7 ROAS. You have to wait like 6 months to get your money back. It just doesn't work in North Jersey. Some other people in different parts of the country still make a killing on it, but we just haven't had much success in recent years.
I think definitely it still works, though. People do it. I mean, people definitely do it.
Yeah, no, people crush it. I just think that we're in a really saturated market. So, but anyway, please continue.
Sure. So from this was 01 to 03, 04. We're booming. We were still figuring things out, but we were making good money. We had a lot of people coming in from California and New York to buy cheap properties up in Rochester. So I would put things on LoopNet at a 18% cap rate when, New York is 4 or 5 or 3 or, 0 practically. And so people were flying in and buying houses. They're taking their equity from New York and California and buying properties up in Rochester. So, we had a really good run. One of the challenges, though, is this was the turnkey model, and there was really not a lot of good property management companies. And these were, C neighborhoods in many cases. That's where we were able to find. Sometimes we'd find houses for $10,000, $12,000, fix them up, sell them for $50,000.
Right.
And we wanted to do well by our investors, so we ended up creating our own management company, which is definitely a money pit, and it's also it's a thankless job. And since we were the ones that sold them the houses too, we would eat repairs. Whenever possible, and it was meant to be a loss leader, but it became a real loss leader, and we certainly gave back a good chunk of the profits we were making on many deals, and just creating a headache and creating myself a job I hated.
Yeah.
And fast forward around 2006, I mean, we saw the writing on the wall early for it was starting to take longer to get loans done. We had a lot of people using Countrywide, IndyMac, First Franklin, basically every mortgage company that went out of business. Those are the ones that were generally doing cash out refinances and or investment property purchases. So eventually the business just kind of came to a stall.
So you're buying houses, you're fixing them up, and then you have guys looking for like turnkey, the 18% on their money kind of thing, and then you're managing them for the investor.
Exactly. Yeah. Okay. Yeah. It was a bulk. Probably 80% of our business was turnkey out of town investors. And we did do some wholesale locally if it was more of a suburban property, or if it was something that was a real heavy lift that was better for a general contractor. We would lay those deals off. And in hindsight, we did better. Those deals where it was a pure wholesale to, a proper general contractor, we did better, made a much higher return than trying to do it ourselves.
because then you were stuck managing it after effect.
Exactly.
And you didn't own it.
Exactly. You know, but it's what you do when you're, you know,
We
kind of.
don't even
young
like
and-
managing our own properties. Managing someone else's that we don't own. I can't.
Yeah, the downside too is this is Rochester money, not New York City metro area, North Jersey money. So the margins were a lot thinner as well.
Got it. Okay, so you're buying properties, you're fixing them up, you're selling turnkey to investors in New York, and then you see the writing on the wall in '06 and you start slowing down. Is that?
I mean, some of that is in hindsight. I saw that. Yeah, we saw some of it on the wall, but you know, it certainly didn't get out fully unscathed. You know, we had a team of people, and I didn't have a mortgage company, and I didn't see that. There was actually people from Rochester that were doing loans in California. I think there was a company called Mortgage IT. So there's a bunch of people sitting in Rochester just doing direct mail to California and Phoenix and making $100,000 a month from Rochester. But I just never thought there was money in mortgages because I saw these $100,000, $200,000 houses in Rochester. It's like not worth the paperwork.
Right.
So yeah, the business kind of just froze up. It was harder to get deals done, and it was a pretty scary time. Yeah. And it was fortunately most of my properties weren't really underwater, but it was really tough to get deals done, and we had more overhead than the typical rental supported at the time. So we really needed to make money on flipping and having the extra income come in. So it was a grind. I didn't go fully broke, but pretty close, and actually had a couple properties that just kind of got caught in. So I ended up having to walk from a few properties in '08, and most of the rest of them were able to sell, or I gave them to a business partner when I moved down to New York City, just because they were basically break even. There's no equity, and you really had to kind of just be there on site to manage them yourself. So it was a tough time, and it was one of those things where I was 28, 29 years old, thought I was going to be retired by 30, 31, and all of a sudden it was really just kind of a internal crisis of confidence as well. I remember that being worried that it was just. Was I naive to think I could make it? Growing up in Jackson, New Jersey, just like a working class, middle class family, it was really an ego check for sure. And it took me a few months to really get my wits about me. But ultimately, that crash was probably the best thing that happened to me, though, because I ended up at a private equity fund in New York that needed real estate people because they were buying the non-performing mortgages. So I ended up coming down to New York City, and December 2008, I'm working on Wall Street at a fund buying non-performing mortgages. Wow. And they needed somebody that could kind of review short sales. They were actually selling loans to investors. So the fact that I had turnkey experience was great because they were creating a new market of selling loans. And a lot of real estate investors at the time were moving into buying the debt on it. So it was certainly a great pivot that would have never happened without a little bit of pain from the financial crisis.
That's amazing. I mean, I feel like we kind of went through that a little bit, right? Because for a little while we were just straight wholesaling, right? And, buying some properties here and there. And then COVID happened, and that was like kind of like a gut check. It's like, I was 27 at the time. You're 24, 25. And we had just went from making like more money than we ever thought we'd be making. And then, we get COVID goes away, and we're back to making money. We're killing it again. And then all the rate hikes happen, and everything slows down. It's just, and I think for us, it was the same thing. It's like, are we actually good at this, or we just got lucky before? And then, we had to pivot, and now we figured out, a lot of other ways to make money. And for us, it's been probably the best thing that could have happened to us, is because, we didn't, otherwise we'd just be cocky blowing money everywhere. Right. So I think that's, for a lot of people, that gut check, in the moment seems probably like the worst possible thing that could happen. But then always looking back, it's like, wow, I really needed that. Right.
Absolutely. And the one thing I've taken away from that when I look at businesses now is it a trade or a business? And to some extent, what we were in at the time was a bit of a trade, because we were managing these properties for thin margin. We were making money one time, as opposed to, some of them, if we would have bought low, kept our basis low, just rented, done the renovations and just lived off that cash flow, we would have been in a different position. But, it's also the challenge of being young and undercapitalized. And, one of my mentors, and he had semi-retired and moved up to Rochester, and he, when things were getting tough, was one of the lifelines, provided some capital and was, really just kind of almost came in as a new partner in the business. And he said there's nothing, there's really nothing you really did wrong other than you're undercapitalized, and that's why a majority of businesses fail. Is you're undercapitalized, and ultimately you run out of money, you fail.
Right.
Yeah, that's a good point. I mean, I sometimes think that if we had bought the properties that we wholesaled, I mean, we would be loaded.
Yeah.
Like if we just raised a couple bucks instead of got greedy on making that $40,000, $50,000, $60,000 wholesale fee, and just took a smaller bite up front, maybe an AC fee, and just kept that. I mean, dude, we'd be sitting really, really, really pretty.
Yeah, but definitely would have required some investment at some point, right?
Yeah, absolutely. And you got to, it's, somebody, maybe you have a rich uncle and you're able to just do it, or maybe you've got the right connections. But yeah, most people, at least your first time through, you end up bird dogging and just generating. You got to generate your initial million. They say the first million's the hardest.
Yeah. Right.
And so I think it's something that I think most people go through. I think back to Rochester now, and I have mortgages that would have been paid off. I assumed a 15-year. One of the loans I assumed was a 15-year loan. That would have definitely been paid off. There would have been others that, would be so far down, it'd probably be close to paid off at this point. Now, granted, I knowing me, I probably would have refied them all when rates were at 3%, but that's a whole different story.
Well, you would refi them at like 4, and then again at 3,
Yeah.
and then at like 2.5 again.
Yeah. End up paying $100,000 in points by the time we're all said and done.
I mean, John, you probably see that, right? People were constantly refinancing.
Oh yeah, people were trying
on the way down.
Yeah, when rates were at their lowest, I was closing some deals at like 2.75, 2.8. Yeah, people were refinancing as they were just trying to refi as much as humanly possible.
It's like oh man, I got into the game with the dream that financial freedom, buy properties, keep them low leverage, really milk the coupon clippers, get the cash flow going, and then you have an opportunity to pull out like $600,000 on a refi and it put $600,000 in your pocket. And it's really, really hard to say no to $600,000 at 3%, but it's the people that do, the people that have been in the game a long, long time that they'll all tell you low leverage, if you can pay off as much of the mortgage as you can. I mean, it's like old wisdom that is really hard to listen to.
Yeah, it depends on your situation. I mean, you're an active investor. You have plenty of places to deploy that capital. The guy who takes that $600,000 and buys a boat, that's not a good use of the capital.
Right.
That's true. Yeah, we did take that $600,000 and dump it back into the business. Yeah,
definitely.
As long as you avoided the 3 Fs when you made your first million.
What are those?
Anything that flies, floats, or you rent, you don't buy.
Wow.
And that's not even a sexist comment because that could go both ways.
They could.
I mean, we know some lady bosses in CG.
Yeah. And they
Flies, floats.
Some do all 3. Yeah, I don't know if you're picking up where I'm putting it. Let's move on.
That may get edited out.
Yeah, it might. All right. So, you're at a private equity company. You're doing, I guess, are you doing like workouts or?
Yeah, it was a combination of analyzing, valuations of properties, figure out which ones had equity. Really, just we would buy 1,000 loans at a time, and most of them were non-performing second mortgage home equity lines of credit. So when National City failed, PNC took over. Then PNC sold a couple $100 million of non-performing seconds for, I think the entire portfolio was 3 cents on the dollar. I mean, this is 2009.
What? 3 cents on the dollar?
3 cents on the dollar. And there were California $400,000, $500,000 home equity lines of credit on there. But at the time, there was no modification programs formally. I mean, we didn't know if half the portfolio would get foreclosed out, 80% of it. It was really difficult to model that. And really, you didn't even know what had equity or what didn't. Because when you're buying 1,000 loans, you're not going to do 1,000 appraisals or even 1,000 brokers' price opinions. You're trying your best to use whatever, Zillow or Realty, whatever was around at the time. And you just know that sort of the law of large numbers will work out, and a certain percentage are still going to have equity, because there were people that had really low first and just took a large HELOC out and maxed it just because it was, I mean, most of the banks then had no closing cost HELOCs. Mm-hmm. So there were definitely deals that had equity. And so, I was doing a combination of just doing a deeper dive in the valuations of deals to figure out, which ones could we foreclose from second position. And, I'm sure everyone in this room probably knows this, but you could foreclose from second position. You don't have to pay off the first. You can reinstate the first. And the first, it's usually going to some lockbox, like a P.O. box. So if you send in a check, if the person's if you foreclose from second position and that person's $15,000, $20,000 behind in their first mortgage, you just send in 20 grand to the address on the statement, and that loan's current, and you just send in a check every month, and you have non-recourse financing now. So it was a combination of figuring out which deals do we foreclose, which deals do we do modifications on. And we did a ton of modifications at the time because there were a lot of properties that were, close to underwater. But we learned that there's a lot of emotional equity too. There were people that were, if you look at Zillow, 100,000 underwater, they didn't want to move. And if their credit was already messed up, maybe because they were behind on their second already, so they couldn't go buy something else cheap. And as the modifications started happening and the government started forcing modifications, it was really a gold mine because the first liens got modified often at 3%. They would take any past due payments, put it on the end of the loan, and we would do a lot of the same thing, or we'd offer discounted settlements. Some people had some money saved and they were strategically defaulting because they thought the loan was just going to get wiped out. And when they realized we were there, we own it, and we could foreclose if we wanted to, but that we were also willing to make a deal. We had loans we paid $5,000 for and would settle for $30,000, and they had a $100,000 balance. So it was a really, really cool time because it was really the first time that banks didn't own the loans, and people were shocked that they're dealing with this small company that could really make a deal with them if they wanted to. And the majority of people were honest people that just ran into a tough time, and if they lost their job and got a new job, and we didn't need 55 pieces of information. It's like, send us your pay stub, show us what you make, fill out a 1-page modification form. And we just made smart decisions where some of the big banks, if you're missing your third year of tax returns, they would just automatically deny it. So we would even pick up applications that were denied previously, and we just look at them as like, hey, this person can pay, let's make a deal. So I learned a lot there. And then I also started selling loans. So I had a lot of other investors that were buying performing loans. We would modify loans and sell them to investors for cash flow.
Right.
It's great business. Problem is, and the owner of this company is kind of infamous in the space. And I was there about a year and a half, and just didn't really see any path to make real money. There was a lot of promises, but ultimately, I saw how much money a lot of the clients were making in the business, and I'd been an entrepreneur myself, and it's like, this is not the spot where I'm going to grind and make millions of dollars. I'm not going to make it working for, not that you can't do it working for someone else that's a good partner, but in this case, I didn't think I was going to make any money staying. So I ended up leaving and then doing some brokering for a few of my clients, and eventually linked up with just a guy in New York who owned a couple office buildings. We met at one of the just New York real estate conferences. And at the time, I also put my license for the commercial brokerage. The thought was I would, go to like New York Community Bank and a lot of the community banks and maybe find some non-performing loans and broker on the commercial side. And was close on a couple deals, but never quite got that big 6-7 figure commission for doing a large deal in New York. That's a tough business. But because of that, I met this guy, and he put up a few $1 million, and we just started buying residential loans again. And that was about 2 years of just using a few $1 million, buying and selling loans. And it was a good lifestyle business. We wanted to purposely wait 2 years to build a track record, and we were making enough that it was a comfortable living. I was personally very happy because after all the stress of all those years, and then grinding for a couple of years on Wall Street, if a conference started in Vegas on, a Thursday, I'd be going out the prior Thursday, have the weekend in Vegas, work remote. It was a great time. And just about 2 years in, though, somebody hit me up on LinkedIn. They wanted to talk about, buying non-performing loans. And, we meet at the Lowe's Hotel in Manhattan. I think it's like 5th and 50 something. Yep. And I think it's like a couple guys from Long Island that maybe have a few $100,000. And, I'd get a lot of those calls. And it turned out it was a couple ex-Bear Stearns guys that had $140 million and, were relaunching their fund that they used to run inside Bear Stearns as a prop desk. And, took this meeting, and, it was a good meeting, but I didn't leave it saying like, oh, they're going to give me money. It was really like an exploratory meeting. It was like, hey, we'll stay in touch and see what, what could happen. That night, though, we the old partner that gave me a few $1,000,000. He was a member of the club called the University Club, which is not the kind of club I can get a membership to myself in general. But yeah, we go there for dinner, and then we go into the tap room after for a drink, and the CEO is there with the CIO. So it's one of those
Wow.
fate, luck. I think just seeing them again that night, had probably had something to do with getting the relationship further. It's like, okay, this guy's, he can get into the University Club. This can't be a complete screw up.
Right.
And about a month later, I had a portfolio that we saw. I sent it to them, and they wanted to start a test fund. So started with a $10 million science experiment, as they called it, and we helped them deploy 10 million, and then did another 10, and then.
Deploying into notes?
Yeah, to buy portfolios. So
Okay.
I was buying smaller, when we had $2-3 million, we were buying 5, 10, 15, 20 loans at a time. Once we had real money behind us, I went to Fortress, Nomura. We were going to the bigger guys, and we were able to get some portfolios off of them as well. And, all of a sudden we had about $100 million purchased, and we had to co-invest 1% of that. So, we have $1 million into deals. And we had a carried interest on top of that, but it's like we're eventually going to run out of co-investment money because they wanted to go bigger. So they ended up partially acquiring us and said, okay, you don't have to co-invest anymore, but we're starting a new entity. You'll own a smaller piece of it, and this entity gets a piece of carried interest on a much larger number. So it was amazing, but I also didn't know what I didn't know at the time, and that led to some of the future stresses I had because I thought, it's carried interest. If you have to beat a certain return and you do it, it's going to be taxed at 20%. But because we weren't the owner of the big fund, we weren't technically a GP, we were technically a subsidiary that was receiving fees. So I had eventually built up all this money that was going to get taxed at 50% like a Wall Street bonus.
Oh.
Yeah. And it completely changed the math on my, my thoughts on hitting my number and slowing down. Because, I got into real estate to, not that I'm afraid to work, but I got into real estate because I wanted to control my time. And unfortunately, this was that Wall Street culture. And even another business partner who I brought in, who I worked with at that original firm, just kind of grew up in that Wall Street culture. It's like grind, grind, grind. I heard more than once it was sort of a badge of honor that wake up before your kids are awake. You don't get home until after it's dark and your kids are asleep. And it was like a badge of honor that you don't see your kids during the week. And I was like, being an entrepreneur, like I know you can do better than that. I know that there's better out there. So it was, it was something I kind of battled with, and there were some political things that came from that, just because if something goes wrong, and it's like, well, Jack's not in the office 90 hours a week, so this went wrong, and it would have went wrong anyway. We were in transitions for things, so you just have growing pains when you buy 30,000 loans in a bunch of years. So. It created some stress. I became a proper New Yorker. I went to see a shrink. It's like the other badge of honor for New York City. And the thing was, I couldn't sleep, and I couldn't open my mouth all the way. The stress was causing TMJ in my jaw.
Oh, jeez.
So, I ended up, going to see somebody, got some anti-anxiety. And, once I made the decision to leave, everything went away. Look, they at the end of the day, they treated me all right. The other crazy thing is taxes. When you're a real estate professional and you're in the business, it's usually not as much of an issue because you get a lot of depreciation. But I was, on the debt side of it, there's really not tax benefits for being a mortgage lender or buying loans in hedge funds. So, everything was at 50%, and I owned a piece of the company. So while I was working as an employee, it was all active income, and I was literally making more from owning the company than my salary. So it's like, why am I going through all this when I'm only I'm basically working for half of every dollar I work for as salary. Once I left as an employee, it became passive income. So I technically made money by quitting and leaving, because now it was all passive, and I could use those investments to, invest in things passively. So it's just
crazy.
Really weird math when, if you're a business owner and also an employee, and it's something that a lot of entrepreneurs who are still working full time in their business, it's an interesting calculation you need to make on, is it worth still running your business, or do you take on a partner, bring in a CEO? How do you figure out how to transition when you're at a point where your business is mature enough that you may either be able to sell it or have it run without you grinding day to day?
That's pretty amazing, man. So you actually ended up leaving the company on passive income, net of taxes, made more money.
Yeah, at the time, yeah, it worked out better. Now, the moment I wasn't there working as an employee, I wanted to get bought out. They, somewhat wanted to buy me out. I was just, because of some of the things that happened, I was a bit afraid that they were gonna, give everyone big raises and all of a sudden take away some of my just because some of the, butting heads and bad blood. And ultimately, I said they took, I think reasonable care of me. And, I also moved to Puerto Rico. So, by getting bought out, it ended up being pretty efficient because I moved. And then it was a couple of years later, I finally got bought out. But, it became apparent that like a buyout might be a better, more efficient way to go, so I could have more money in my pocket. It gave them a slightly better deal. So ultimately it all worked out. And now, I live in Puerto Rico. I'm a block from the beach. There's incredible tax incentives down there. And there's about 10,000 people who've moved in the last 8 years that are entrepreneurs. So the scene down there is incredible. There's everything from, stock traders, options traders, crypto, guys like Peter Schiff moved down there. Yep. And just a lot of just random people who just have random businesses. Really anything you could do remote where you don't have to physically be on site, including a lot of internet marketing people, some podcast hosts. I think John Dumas, Entrepreneurs on Fire, is down there. It's a really interesting collection of people, and that's what's keeping me there. Is it's like any day you could be in a meeting like this with a couple successful entrepreneurs that are just good guys that want to come out and talk business. So it's been great. It's like joining a country club, but instead of paying your dues, you save 90% on your taxes.
I love that.
And we were talking about this before. You said the capital gains taxes. There is no capital gains tax in Puerto Rico. Is that correct?
Yeah. So as part of the tax decree, and this is the one part that's a little more controversial to the locals. When you move there and get it's now filed under Act 60. There's no short-term or long-term capital gains tax for, I believe, 20 years. And that's on Puerto Rico sourced income. So that's stocks, options, that type of stuff. Real estate is still taxed where the properties are. Mm-hmm. So real estate would still be U.S. sourced. But for active stock traders and for options, there's a lot of options traders, a lot of crypto traders down there, completely tax-free. Whereas in the States, it would be short-term. So they're going to be paying, likely 50% tax rate if they're a good trader. So that part's lured a lot of people. The other part of it is the Export Services Act. So that includes fund managers. I know there's some lawyers down there. There's radiologists even, where essentially if you have a business and you make money from off island, the island only charges you a 4% tax. And then there's no tax on the dividends you pay yourself, from the profits from the company. Mm-hmm. And you don't pay federal income tax if you're a bona fide resident of Puerto Rico. So it's an incredible opportunity. And that's open to locals as well. But if you're just like a standard lawyer or somebody who makes money just on the island of Puerto Rico, generally the tax rate's 33%. So without the incentives, it doesn't make sense financially to go there. But the Puerto Rican population had been in decline for about 20 years. There's been a long recession. So it's an aging population, and they needed to do something to recruit more people to the island. And I love it there, but it was not on my radar. I wouldn't have just picked up and moved there randomly. Maybe Florida. I think most people, the typical thing to do is you go to Florida because you save on the state tax, and the awareness still isn't there. I think a lot of people that move to Florida, if they really knew, they'd probably go further down to Puerto Rico. And I know I've paid a fair amount of tax to the island, and I spend a lot of money down there. So I think it's been good for the island. There is a little bit of a vocal minority. There's a gringo go home movement. So there's a little bit of noise from people who just disagree or don't. But nothing that's caused any. I've never had any issues myself. Everyone's been super friendly to me down there, and very happy down there. And I still get to come up to Jersey and hang out and have meetings and But ultimately after that, I avoid the winter here for sure.
That's awesome.
You do have people in New York bragging about having a therapist. Right, like that's like a thing. Like, I spoke to my therapist. Definitely in Puerto Rico, they're not bragging about having therapists. I don't think.
Yeah, you just walk half a block to the beach and you're like,
that is your therapist.
Yeah,
that's kind of crazy that a job can put you in that position. But I mean, you're still you're still obviously working, right? I mean, it's not.
Yeah. So, I guess to finish the long-winded, this is my life story. So, so I was down in Puerto Rico. I took 2019, and I had a non-compete anyway. So, I took 2019, and I did this executive MBA program through Kellogg School of Management, Northwestern in Chicago. They have a global MBA program where you basically travel to a bunch of sister campuses in different parts of the world, and Hong Kong being one of the biggest, their biggest partner. So 2019, I was back and forth to Asia, I think 6 or 7 times. We had classes in Tel Aviv, Israel. So got to do Jordan, did Petra and Wadi Rum. There's also a campus in Miami, and spent the year, basically traveling. And what you do is you spend a week at a time in class. So it wasn't like this Friday, Saturday program where, you show up, maybe you have a beer here and there with your classmates. This is like you're living in a hotel together for a week, and people are flying in from, there's people flying in from Singapore. One of the guys was flying in from Israel. One of our friends flew in from Moscow. I hope he's doing okay, right now. One of the guys was flying from Australia. And it was like once a month you fly in for about a week. And it was an amazing cohort, made a lot of friends. And I realized a lot of people were in that same boat. I was like 40. So a lot of people were kind of going through that mid-career crisis, trying to figure out what's next. And they were doing this MBA program to try to just figure that out. So it's a great time to clear my head because I'd been kind of heads down in real estate for close to 20 years. And the last 10 certainly, just really, in a very specific niche of mortgages. And, I was still doing a little real estate on the side. So to get to what I'm doing now, I'd been passively investing into some multifamily syndication deals just because I wasn't allowed to buy loans and I don't really trust the stock market. So I really wanted to have money into, passive income secured by real estate. And, there were some tax advantages, even with the W-2, rather than owning a REIT that was going to get taxed at 29% for dividends, I was getting positive cash flow from these syndications, but showing a loss on my taxes. So it was tax deferred income. So, I was already familiar with that business. And once I was looking to figure out what to do next, and I, had some money saved up, and once I got bought out, I actually had a pile of money to deploy, which is also a scary thing. It's one thing when you're making $100,000 here, $200,000 here on a deal, but when you get multiple 7 figures thrown in your bank account at once, and you're worried about inflation, it was, and you don't want to do anything stupid too, because I was already married, so avoid the at least one of the 3 Fs was set, but the boats and the airplanes, actually I didn't have airplane money anyway, but could have certainly wasted it on a boat. And as I was figuring out what to do, a few of the groups I'd invested with came to me, similar to David, how I came to you. And, they said, have you thought about capital raising? We have got a great base of investors, but when we have to raise $10 million in 30 or 60 days, we need partners that can help and want to partner with us. Because, often just people, even great operators will exhaust their network of friends and family. And even better, there's some great operators who are just not good marketers. They want to focus on, just being really efficient with building, raising rents and renovating apartments. And they don't want to be on the phone all day, telling the same story. And fortunately for me, it's like, I love that stuff. I've always been an evangelist for getting into real estate at whatever angle makes sense. And I'm getting to that age as well where, I focus more on lifestyle, and a lot of my counterparts, in their 40s are starting to think about their kids' college and their own retirement. So it's a logical time for me to help, sort of them accomplish their goals. Because when I was in my 20s, I'd be like, buy a 2-family house, live in half of it. My friends are in their 40s. They've got their, their house on a cul-de-sac, or their kids' soccer games. They don't have the time to do the same hustle that you do when you're 10, 15 years younger. So, and they're also, a lot of them are paying a lot in taxes too. So my 2 favorite things are to help advise them on how to do things passively and how to save money on taxes. So it's great. I'm happy. It's a lifestyle business to some extent. Just because it doesn't really feel like work.
So now you're I guess you're helping raise money, but it started with, you're investing alongside operators and syndications or in funds. I mean, you touched on something that I think everybody in this room knows, but maybe not everybody listening knows, and the advantages of investing in a syndication versus, stocks or a REIT or something else that, you can't defer taxes. Or just, can you explain why that's advantageous, or at least in your eyes?
Yeah. So, look, I mean, I think this is, something that I think a lot more people should know about. Of people that are, you need to be an accredited investor for majority of these deals. So that means you need to have either $1 million net worth or make $200,000 a year if you're single or $300,000 if you're married. And these have been the same rules for 20 or 30 years. So it used to be, country club type deals, but now it's open. There's a lot of people that are worth $1 million, and it also can include your retirement account. So, even if you've never made $300,000 a year in your life, but you've been at the same company 20 years and you've got $2 million in your 401k, that counts. So your net worth is there. So these deals are somewhat under the radar, but with the change in the laws, I think it was 2017 with the thing called the Jobs Act, and with just the way the internet is now, they changed the rules to make it easier to advertise these deals, because there used to be, very regulated, where if you didn't have a pre-existing relationship, you can get slapped by the SEC. So these were kind of secret country club type deals, and now they're open to more, just more investors. So the reason there's a couple of reasons they're advantage. Number one is, it's not like it's traded on the stock exchange. If you have a publicly traded REIT, you could click a button and buy or sell it. There's institutions investing in these firms, so they're just going to take a lower return. When you are in these private deals, you just need to offer a higher return to investors in general to get their attention, because they're going to say, well, why would I? And I've gotten this question from an investor. Why would I invest with you instead of just putting money into like VNQ, the REIT index that pays a 5% dividend? It's like, well, A, we'll pay an 8% preferred return, not a 5. And B, ultimately over 3 to 5 years, your total return, could be 15 to 20% annualized, or IRR, which, I've realized a lot of people just don't really understand IRR, and it's ultimately you need to put it in Excel. But it's loosely correlated to an average annual return. But if you get your money back a month earlier, the number will change a lot more. In IRR is a more exact number, and ultimately it's you're over time going to get a higher return in the stock market. And it seems too good to be true, but if you think about, even if you own a business, whether you own a restaurant or a laundromat, many businesses have 20, 30, 40% profit margins. So if you think about these real estate syndications as buying into a business, it's feasible to make 20, 30% profit margin. So it's feasible to make 15, 20% return, especially when the operating partners, the general partner, the one that's doing all the sweat equity, they're incentivized to get you all your money back plus a return, and that's how they make the rest of the return. So even if the deal makes a 30%, you're getting 15, maybe they're getting 10 to 15 at the end of the day, for executing it profitably. So, it's a great business model. And I think that the percentage of millionaires worth 1 to 10 million that have money in private deals or real estate is way lower than it should be. The family offices, the people that are worth 50, 100, $200 million, most of them have over half of their wealth into real estate and private equity.
Wow. Versus
that 1 to 10 million. Often they have 80, 90% of their money just in the traditional financial system of stocks and bonds. And to remind on the tax side of it, most of these deals, because of depreciation, will actually spit off tax deferred income. And the only time you'll pay tax is when the properties sell, and it's often between 3 and 7 years. And if structured the right way, there's often an opportunity to do what's called a 1031 exchange. Even if you're in a syndication, I've been in multiple deals where they gave people the option to sort of flip into another property if they want to. And then those that wanted their money back, they're able to do something like an internal transfer and give the investors their money back. It's certainly not a guarantee when you're in a syndication, but there's plenty of ways to be tax efficient.
I got a question for you, Jack. I think I was excited to ask you this question since I found that you were going to be here. You've been able to, in the last downturn, you were able to make a killing, right? You saw an opportunity, you jumped, and you made a couple $1 million through it. I think we're kind of coming to, I don't know if it's necessarily going to be that bad, like 2008, because for houses at least, there's no inventory. Right, people are locked in at a 3% interest rate. They're not going to sell their property to basically borrow at 7% and pay significantly more on their monthly payment. Right, so there's a lack of inventory. I think that's kind of holding up house prices. On the commercial side, multifamily, office, industrial, retail. I think that we're going to definitely we're already seeing some adjustments in pricing, and there's a lot of maturing loans coming due, and that I just feel like is a ginormous opportunity for the right private equity firm, the right investor. Where are you seeing the market going, and how are you going to monetize on this opportunity?
Sure. So, great question, and it's good timing too, because I've gotten sent 3 deals in the last week that are in some level of distress and these were multifamily deals. They had bridge loans that had variable interest rates and generally had interest rate caps. One of the other deals is actually a 10-year loan, but the first 3 years was interest only, and they're coming up to that 3-year horizon where it's going to be amortizing, and that's going to put them in a negative cash flow situation. And they were behind on their renovation plans, so they need an influx of cash. So I agree it's not going to be 2008. I think the percentage of people in bridge loans is still a relatively, it's a vocal minority of the loans in the space. There's still a great majority of people did Fannie or Freddie fixed rate loans. But the fact is rates are higher, and it's going to put pressure on a number of operators. And I think there's a great opportunity to be a bailout on those types of deals, whether it's coming in for pref equity to be in a senior position and just have just a solid risk-adjusted return, or to either just acquire the building at a reasonable discount to the top-end value, or even just be a bailout partner. And some of the current investors may get diluted, but if you're coming in for that extra $2-3 million to get the property over the hump, finish renovations, and get to the point where it can sell as a completed value add and with a much higher net operating income, there's going to be opportunities to make, I think, 30, 40, 50% type IRRs on those deals. Office, retail, I think the real money in this cycle is going to be in those types of, it's the blood in the streets type of assets. The office building that's, was bought 100% occupied with much higher rents and is now 50% occupied with 50% lower rents or 40% lower rents in some cases. So those are going to be interesting opportunities to, in some cases, just take advantage of an economic situation. And a building that was a 5 cap a couple of years ago might be a 10 cap at a much lower price now. And so sometimes it could just be buy and hold. But I think the repositioning, I was in the financial district in 2008, 9, 10, and there were Class B office buildings that were renting for $35 a square foot that when converted to residential were $70 a square foot. So I think there's going to be a lot of opportunity to turn, mixed use in office into apartments. The random suburban office park, that's going to be a much heavier lift, but there's still a housing shortage. So maybe some of those get torn down. Maybe some of them could be converted to apartments. The struggling retail, it's a great spot to build apartments around retail. A strip mall, you still need grocery stores, you still need some of the stores in there. So maybe I've seen these in plenty, we've all seen them in plenty of towns. So I think, it's going to be a roll your sleeves up and be a little bit more creative, on the repositioning, and potential development as well. Self-storage still in growth markets. I know people buy self-storage and build another building next door. And that's the next level. And I think, you guys have, you've got a great business going already, but as you're expanding, you've got that multifamily building. I think you're gonna see some interesting opportunities because of what you're already doing, and deals are gonna come to you. And the next step is to capitalize on the deals that take a lot more work. That you need to figure out the zoning and the entitlements, and it's fun too. And I'm looking forward more to diving into some of that stuff as well, because I've never actually built something ground up, and even though I talk about not creating myself extra work or stress, I think building something would be kind of fun. And
building buildings. So I mean, you have a ton of investors that work with you. I guess technically clients, right? And you're deploying their capital into different investment opportunities, and I'm assuming most are real estate related, right? With everything going on, Elon Musk came out, what was it, like a couple days ago, and said, commercial real estate is dying, and the housing market's next. It's got to strike some fear into some investors, I would think. I mean, have your investors approached you about what's going on, and if they if so, what are you telling them?
Yeah, I mean that's been a pretty constant thing over the last year. I get calls practically. I talk to usually talk to at least one or two investors daily, and as soon as interest rates started moving, as soon as you'd see the articles on CNBC or the Wall Street Journal, it's it's weekly. There's some negative headline out there, so a lot of discussion about what you see for the residential side of the housing sector does not necessarily mean it's bad for the commercial side, and especially the apartment side of things. When you have interest rates that are the highest they've been in 20 years, you've got a generation of people that are priced out of buying a single family home right now for the most part.
That's a good point.
So seeing that housing prices are declining 5% is not gonna make the difference for somebody who makes $70,000 a year, and the average cost of a house in this part of, just use Jersey as an example, was it 500, 600? It's hard to get into, something for less than 3,000-4,000 a month. And if you could rent for 2,500 a month, it's the affordability index right now. I think it's basically, I think all but 2 states, it's cheaper to rent than to buy right now, which, there's many, for years it was the other way around where you could actually save money by buying a house. I know some crypto people that really think that, and maybe this is something with Elon as well. There's a couple of crypto people who really just think that the efficiency eventually of the blockchain is gonna kind of suck a lot of money out of the real estate market into the crypto market. And I own a little bit of crypto. I keep an eye on the space, but I'm certainly not. I just maybe they're right, and I'm just missing something. But I just don't see that. I think that's a little bit of that utopian blockchain, libertarian leaning, new world order type thing. So to me, if that happens, it's like probably multiple cycles away from now. I do have moments where I worry about the US dollar. That was part of the reason of going to Hong Kong. I just wanted to get out of the bubble. I wanted to have connections in different parts of the world. And, we've got 30 trillion in debt right now. So, I mean, at some point the debt's going to be an issue, but we're still, to some extent, too big to fail, and it doesn't seem like the world trusts. China's not even what they call it, capital account convertible. I mean, because there's capital controls there. You can't be a reserve currency if you're not able to freely move money in and out of the country. So, at least for the short term, I don't really worry about the U.S. dollar collapsing. But I think it's also feasible that we have prolonged inflation, and the Fed basically moves the goalposts and says, okay, we're just going to accept 5% inflation. And in reality, it's 10 when you look at how they calculated it 20 years ago through shadow stats. So, when I look at real estate and having reasonable leverage, it is a hedge against inflation. And as someone who's essentially living off his investments for the most part at this point, because JKAM, we don't live off of our fees. We live off of the rents and the distributions, and my largest investments in my own fund. So inflation is a bigger risk for me too, because I'm essentially on an income of investments, and I need to spit off enough to pay rent and spend $10 for eggs. So that's a concern, but I do worry a bit about inflation and just being positioned to hedge properly against it.
And you still feel like real estate, at least multifamily real estate is a good spot to be placing your capital.
Yeah, I mean, for me, I love all of the kind of syndicated assets. So if you got multifamily, self-storage, mobile home parks, student housing, senior living, ground-up development, build-to-rent, all of them have some benefits. But multifamily to me is the core. And I'm expecting to have 50 to 70% of my investments into multifamily housing. Specifically on the value add, it's a pretty basic business model. You buy an old entire apartment building where the prior ownership wasn't renovating apartments; they were just throwing a coat of paint on it. They've still got the Formica countertops from the '80s, and when you buy one of those buildings, you could put $10,000, $15,000 into a unit, and it raises the rent $300 to $400. That's worth $80,000 to $100,000 in increased value just on one unit. So that math works in any market. Yeah. If rates go to 9%, if rates drop to 0, when you could create that much value, you're going to be okay.
You guys have seen that chart? It's the affordability of renting versus buying, and it's like it's so much larger now than it's ever been ever. It's kind of crazy. It crossed like 2 years ago, and now it's just like, I mean, it's so much cheaper to rent than to buy right now. So.
Yeah, and this is drastically different than like most of the prior cycles. It's I keep quoting Howard Marks. He has this line: "History may not repeat itself, but it does rhyme." Mm-hmm. And you know, we're going into a recession probably, but what's different this time around is you know, the average baby boomer. You know, baby boomers are between 62 and 70 something. So most of them are retiring, and you know, the Fed's old playbook is raise rates till unemployment shoots up. But right now, there's still a shortage of workers, and there probably will be for a number of years. So, you know, the same playbook that worked in prior cycles may not work this time around. So, you know, you can plan to some extent, but it's not, you know, history, it's not going to be the same exactly each time around. So I'm still always figuring something out.
All right. Well, Jack, it's been a pleasure to have you on the show, man. Thank you so much for just sharing your story. I got a lot out of it. I'm sure that the guests did too.
I mean, you're a world of information. We appreciate it. I mean, where can people find you, right? If they're interested in hearing, you know, more about your story, or just want to ask you questions, want to invest with you, whatever.
Sure. So, yeah, our website is jkaminvestments.com. That's JKAM for JK Asset Management, jkaminvestments.com. We're also on Facebook, Twitter, LinkedIn, even TikTok now. Whoa. So, and we have a podcast ourselves called the Alternative Investor Mastermind. David, you're long overdue to get on the show as well. We don't have as cool of a setup, but you know,
you can use our setup if you want.
Actually, maybe we'll do a pod swap next time, and we'll record from here. And yeah, really appreciate the chat with you guys. It's kind of therapeutic for me as well. It's almost like a therapy session, like stuff to do in New York.
You are close to New York. So.
Yeah, go brag about it. All right, well, we appreciate it. Thanks so much. That's a wrap.
Pleasure.